Happy Tuesday, everybody. I hope you had a nice weekend, recovered from the midterm, and are ready to hit the ground running today. I realize I probably should mention the date on the front of these videos, even though the label's right. So, for future reference, October 13th. Um, just, uh, just a couple of weeks and a few days shy of uh, all of the Halloween stuff, which I guess will be somewhat muted this year. Uh, Either that or everyone looks like, everybody's dressed up. Uh, okay, so I have just a few announcements, and then we're going to actually do the in-class exercise today. So this will be an action class. I'm going to cover a few things, and then you're going to do some work while I step out of the picture for a little bit, and then I step back into the picture after you all struggle around a little bit. It really won't be much of a struggle, and review the things that you got accomplished. Excuse me. And then we switch to the next subtopic within the topic of financial analysis. It's the next step in a formal financial analysis. So we are working on the midterm. I would say feverishly, but that's probably an overstatement just a little bit. But we are working on the midterm, as I put in the post, the announcement on Canvas. Your score that you think you might have gotten based on the actual results from the quiz, if you will, the way it was set up, is probably indicative of your score, but it may not be, and it will may not be your final score. Your final score may be somewhat higher or somewhat lower. Your final score actually may be significantly, I guess, higher. I doubt that it would be significantly lower, but that's possible. Most notably, if you just missed a question because of entering the data incorrectly when you actually have the data correct in your work that you've turned in. If it's your process is completely right, you made some error at the end.
Yeah, sir. I have a question actually.
Yeah.
So I entered like a decimal like just wrong, honestly, and like I had it right on my work. Is that
Yeah. You'll be in good shape. Yeah.
okay?
So,
Okay.
the as I've said before, when we
I just wanted to make sure. I'm
Sure.
sorry.
Oh yeah. No problem. No problem. I'm glad you asked. But as where I was headed there was, as I mentioned before, and it's true not only in this class, but it should be true. I don't want to step on any academic toes here, but it should be true in other classes that what you do at the university. Now I'm not talking about your history and literature classes and things like that, which you don't get enough of, by the way, but that's another story. In general, in the classes that mean something to your immediate application to your profession, in college we do toy problems. We do problems from the back of the chapter. We have made up things, and that's by necessity. It's very difficult. It would be very difficult to completely replicate the real world in the classroom, every element of the real world. So we abstract that down, and what we should be focusing on in the classroom in academics is the process that you go through to in this class to find a solution. The final solution itself, the ultimate answer, numeric answer, is not nearly as important as the process, because we're not educating you on the final answer. We're educating you on the process you use to get there. And I care about you knowing the process to go through. And if your process is incorrect, well, then that's a problem. But if your process is all correct and you make a stupid error, or a not stupid error, just a let's call it a slip up, right? Hang on a second, eye itch. A slip up, well, you shouldn't be, maybe you're penalized a little bit, but you shouldn't be penalized a lot. It just doesn't make any sense, because we're trying to assess your knowledge of the process, not of that final number that gets presented. Now, there's a danger in that. Sorry, I'm philosophizing here a little bit. There's a danger in that when you get out in the real world, the process matters and the final number matters a lot. You can't be off by a factor of 10 and expect to get promoted, right? So the final number matters, but it's not irrelevant to us either, to me, but the process is critical. So that's why we had you turn in your work, in addition to the goofy way we had to do it on Canvas, to actually have you take it and have it timed and all those things. So that's why we're still working on it, and will work on it to make sure that we try our best. We're not perfect. I like to say that I am, but I know deep down that saying that is imperfect. Maybe that's my only flaw. Anyway, that's why we're going to do our best to make sure we give you the credit that you deserve. Some of you, I'm sure, will be unhappy at the outcome and say you deserved more credit than we thought that you did. And well, somebody has to be the final arbiter, and I guess theoretically you can do all sorts of appeals up the line, but essentially the final arbiter is me, and you may end up hating me or loving me. That really doesn't matter. We're going to do the best that we can to be equitable. There's equality and equity aren't the same thing, and equality is something that really we shouldn't be shooting for. We should be shooting for equity, treating everyone the same, and that's what I hope to be able to do. So there we go. That's the midterm news. I also will point out, there's homework from chapter 6 is coming, will be assigned later today or tomorrow. And this is, I'm going to call it busy work homework. And it is just forming a bunch of ratios and financial measures from financial statements. So that's what chapter 6 homework is going to be like, and you'll be busy calculating stuff out. If I get energetic, which these days is more and more difficult, if I get energetic, I'm going to assign the homework in a way that makes it easier for you to do these calculations. So we'll see how much energy I have when I get that done. I'd also like to point out something that might be helpful to you if you haven't noticed in your textbook, and that is in the back of the book. I think it's actually past the interest tables, is a glossary. And if you haven't visited the glossary in your textbook, you might find it very helpful. And you might find it very helpful uh, in this particular chapter. You know, there are a lot of terms that pop up that you may not be familiar with. You may not heard them before. And I would suggest that if you see something that you don't quite understand, uh, the first step would be to consult the glossary in the back of your text. I think you'll find it very, very helpful. Uh, and I know, full disclosure, uh, there was a there was a couple of construction related things in these measures that I was unfamiliar with, and I went to the glossary and bingo, I got it. So it's very helpful. Uh, Finally, before we get to the material for today, this is I gave you a book recommendation several weeks ago. My grandfather's son, that was Clarence Thomas. He calls it memoirs. It's like an autobiography up until the time he joined the Supreme Court, which of course is very timely these days with the Supreme Court nomination of Amy Barrett and all the surrounds, all the debate, argument about that. This is a little different. This is a little broader. I would recommend to you Henry Kissinger's book called World Order. And if you want to know anything about how, why is Europe the way it is? Why is Asia the way it is? Why are the governments the way they are? And the cultures a little bit. And why is the U.S. the way it is? And why is it different? Uh, this is really a fascinating book. You all weren't around for most of Henry Kissinger. He's still living. Henry Kissinger. You might have heard his name. Quite an interesting fellow and wonderful to hear speak. He's got this really deep, gravelly voice. That just YouTube him sometime. Just listen to him talk. He's he's not a natural born citizen of the U.S. I can't remember exactly where he's from, maybe Austria or something. Anyway, uh, you would enjoy this book. It'd take you a while to get through it, and I know you got a lot of stuff to do, a lot of stuff going on. Maybe get some time over Thanksgiving break, or certainly over the holidays. Maybe you can give it a shot. Broaden your horizons a little bit. Okay, so today we're going to finally wipe out, I hope, the sorry, I got paper strewn everywhere this morning. The Big W construction balance sheet. There was a handout. This is the in-class exercise we're going to do today, and that's been posted forever, I think. And I'm going to use the spreadsheet version. We're going to calculate. We did, before the midterm, this a week ago, we were working on this. We're going to polish it off today and do some in-class. You'll do some in-class work on this, and then there'll be just a few of these left for some additional stuff, and then you just turn it in. And so that's what we're going to get finished today. We have that, and I also the spreadsheets posted, and also on Canvas posted a set of files. It's a PDF file that is represents the slides that I hope we will get to later today. The more I drone on, the less the likelihood. I hope we'll get to those today, and that is the pro forma analysis. And that's what those slides are, and they're under today's date in the files, class files section of Canvas. I was looking at the syllabus. Got the syllabus here, and so we've got today and Thursday on analyzing construction companies' financial statements, and we'll be talking about about that. There'll be a homework on public construction companies' financial statements. And then we move into some accounting, construction accounting concepts. This is, whew, boy, this is things that are rough for me, just because it's so focused and to me difficult. And then we do some depreciation, value engineering, and then we're into November. So anyway, we've got today and next time still talking about these financial statements. I hope we'll be finished on Thursday, and then we move into some more accounting related activities. Okay, back to the financial statement. Let me very quickly share up. So this is the document, and you've seen this, especially those that I notice are signed in every class time. I've said this before. I appreciate you being here. It's nice to see familiar names. Anyway, this is where we this was the financial statements, the balance sheet, and then the income statement for Big W. And then we were working on these ratios when we were so cruelly interrupted by the end of class time. So I'm going to polish this off. I will go away from this document and go to the spreadsheet. For financial analysis, accounting, all those things, spreadsheets are king. Even before electronic spreadsheets, accountants kept spreadsheets. Their books essentially are spreadsheets. So the electronic spreadsheets that we use today are really designed after the accounting practice of using spreadsheets. So I'm using the spreadsheet, the in-class spreadsheet, and you'll see it here. This is a replication of the Big W financial stuff, and these are the ratios that we have already calculated to the best of my memory. I should have gone back and looked at the videos. To the best of my memory, where's my, okay, get my notes back. So remember the quick ratio. If we looked at the definition of the quick ratio, and what do we have on hand and can turn into cash on hand and can turn into cash quickly, right? Very quickly, to take care of current liabilities. And so it's the cash plus short-term investments, of which there are none here, plus the receivables. So you see cash plus accounts receivable, and we don't include the retention here. You can include it, you can not include it. Generally, it's not included. And then it's divided by the current liabilities. So to get the denominator, we have to scroll down to current liabilities here, total current liabilities. And we form that ratio, and it's 1.42. I believe we did that a week ago. The current ratio is a little bit different. That's the denominator here. I'm sorry, the numerator here is total current assets. So it's current assets over current liabilities. That's the current ratio. So you should be able to remember that, although you don't need to memorize these, right? Gee, what's the formula? If I'm going to do some liabilities to net worth, what's the formula for that? Well, don't worry about it. You don't have to memorize them. I've never memorized them, but you will memorize some of them naturally because they'll be very critical to your business. When when you get out in the working world, some of these will be fresh on your mind all the time. And those are the important ones for you, and for everybody it'll be a little bit different. So this is current assets over current liabilities. So this number by definition is going to be a little bit higher. And this is all of your assets, current assets, right? So some of them are a little harder to get a hold of than others, and that's why it's not going to be as low as the quick ratio, because your current assets are just very much larger. And finally, we've got current liabilities to net worth. And current liabilities, of course, that's pretty easy. Both these numbers are way down south here. There's your total current liabilities. We used that number before. As you go through these numbers are going to seem very familiar to you because you're going to use them a lot. There's your current liabilities, and the denominator is net worth or total equity. That's the net worth of the firm, whether it be owned by one or owned by many. Will be constituting here the total equity. Notice that you have your own net worth. If you were to do this yourself for a company, this is the company's net worth. Now, there's some other ones here that I want to calculate very quickly, and then I want to turn the work over to you. And I've got all my answers written down, so I want to make sure I end up doing it right and don't lie to you, as I am wont to do. Okay, debt to equity. Here's the next ratio, and of course, it's interesting. In some firms, having a decent amount of debt is not a big deal. In others, having debt is a huge deal. It's a huge negative. And so the debt to equity ratio particularly for different industries, varies. That you want a low one in this industry, you might tolerate a high one in this industry. It's just all the way that the financing happens within that particular industry. Maybe how often the technology changes and it has to be refreshed, stuff like that. So the debt to equity is that ratio is the total debt or liabilities, right, divided by equity. So let's calculate that up. Total debt, liabilities, that's going to be on the liabilities side, right? So this is total, right? Not just current. We've been working with current liabilities so far. This is total liabilities. And so this goes a little bit beyond borrowing sorts of debt. This is, what do we owe to everybody for everything kind of debt, right? What are we liable for? And that's 577, 122. And then equity is the numerator, and of course that's going to be, I'm sorry, I don't know why I'm confusing those today. Is the denominator is equity. And so I just hit the slash for divide by total equity here. And that's that ratio. And there it is. There's a formula for us. And we don't want to see that many decimal places. So 1.29 is the debt to equity ratio. So that tells us that there's uh, the equity held in the firm in the form of uh, equity, owner's equity, and retained earnings. Pardon me. Is not sufficient to pay all the debt, to pay off all the debt, and that's not uncommon. So that's not, that's not you. We don't step back in horror. It's not necessarily a bad thing, as we'll see a little bit later when we talk about comparison of from one company to another. And of course, we could also look at the debt to equity ratio for the past year. I've been using current year numbers here. We could look at last year numbers as well, the debt to equity, and see if that had improved any over the years. Okay, this next ratio is fixed assets. That's plant and equipment, things like that, to net worth. So once again, net worth for us will be that total equity number. And so fixed assets, we've got that number, right? That's very handy. Net fixed assets, they're in line row 23. Net fixed assets will be 154,775. And then we divide that by our by now becoming familiar total equity. And that number will be lower. Notice, so let's think about that number for a minute. 0.35. So that's, how about if we just all the fixed assets that we have, how does that relate to the owner's equity, the owner's equity and the retained earnings, the cash value, if you will, the immediate held value of the firm? So how do those two relate? Just your fixed assets, your plant and equipment, not all these other things going on. And so that's that ratio, and generally that's going to be much, that should be much lower than debt to equity. And so and it's two things that are held, right? This ratio tells you how much of that equity, how much of that held retained value of the firm is taken up, if you will, in a sense, by these fixed assets that are, hard things, physical assets that the company possesses. Last ratio here, let's look at this one: current assets to total assets. And that's a pretty easy calculation, right? That's our total current assets, 690. We'll divide it by the total assets, little over a million and a skosh. And I got to change that somehow. And so we have, that's a 0.67. So we can think about that for a minute, as well. Okay, so our current assets, those things, our cash, and those things that are owed to us, right? Those things coming in the next year, all those things that will generate cash, is about 2/3 of our total, all the total assets that we have. And so those are, our current assets are more fluid, and our what's left over from that in the total assets are the fixed assets and the less fluid assets. less more difficult to turn into cash, if you will. And so if we were to form that, fixed and other assets, a ratio of fixed and other assets to total assets, that'd be a third, right? So we're 2/3 current and 1/3 other. But it's the current typically that that matters. Okay, so I just noticed a couple of chats. The quick ratio formula question is cash plus short-term investments, which in this case, in this example, there are no short-term investments. Okay. So it's the sum of those plus receivables, accounts receivable. So it's, for us, it's the sum of the top two here. And then I'm going to get this right. The denominator is current liabilities. Current liabilities is a denominator for both of those. So the quick ratio formula, that's it. It's your cash plus your short-term investments plus receivables, and we're not including a retention in that formula. Divided by current liabilities. Do you have the cash to eliminate your current liabilities, to pay off, to handle, to address your current liabilities? And then the current ratio is the current ratio is current assets, current liabilities. So it's a ratio between those two. Current assets in the numerator, current liabilities in the denominator. Okay, now what I'd like for you to do, this is your in-class assignment, and you will see, and I just put the numbers down here, and we may not get you may not get through all these, but I'm going to give you some time here. The other ones, we've gone through 1 through 6. These are 1 through 6 on that the document, the in-class exercise page. And so what I'd like for you to do is to calculate for numbers 7 through 13. Now, I need to explain a little something about, let's talk about number 7 before I turn you loose here. And this will apply, I mentioned this briefly last Tuesday, and this will apply to any of these ratios where so far, let me back up just a second. So far, all of these ratios we've been using the balance sheet to calculate those, right? All of them have been assets and liabilities, receivables, cash, net worth, all those things related to all those things. Some of these ratios, I don't know about all of them. What is it, 11, 12, 13? Yeah, maybe all of them, actually. Relate both to, they're gonna pull numbers off the balance sheet and the income statement for the same ratio, the same measure. And when you do that, you've got, and I'm gonna, let's hint it up a little bit. And these are in chapter 6, much more so than you might think. If you haven't looked at chapter 6, we're kind of going through chapter 6 step by step here, almost not quite verbatim, but pretty stinking close. I did that aside there, and now I've lost my complete train of thought. It's you want to go through there. Maybe the definition of all of these ratios is in there, right? It's in there in chapter 6, and several of them, if not all, are in the glossary as well. Back to the glossary. So, for example, let's look at number 7. Number 7 is collection period without retention. What in the heck is that? Okay, so the collection period without retention uses accounts receivable. The formula is accounts receivable times 365, because accounts receivable is also like a snapshot, and we're going to take that times 365 to get sorry, where is the in-class document? Well, it's on Canvas. Let me see if I can, screen sharing is paused. I don't know what that means. I almost can't get to Canvas files. Well, the spreadsheet is under files for today, and the document itself is under the files for a week ago, 10/16. So there's that. So it is all this, the spreadsheet version and PDF version are posted on the Canvas files for class. Okay, good. All right, so it's accounts receivable, which notice is on the balance sheet, times 365 divided by revenues. Notice revenues are on the income statement. So we're crossing the boundaries here. And remember, the income statement is like a movie. It tracks all sorts of activities over time, and it represents those activities over time. Whereas the balance sheet, remember, is a snapshot. So right now, today, how much cash do we have on hand? Right now, today, what's our accounts receivable? What's our building and land book values? All of those. So in order to properly address that, the accounts receivable that we have is going to be an average over the year. So so we've got where we were last year, and then stuff happens that is represented in the income statement, right? All that stuff happens in the income statement, and the result, so we were in a particular place, and all this stuff happened, and then we're in a different place, and that's the current year balance sheet. So it's like sorry Hokies, sorry about the game, but it's like okay, there's the kickoff. Here's the current situation. Here's the kickoff, and a bunch of stuff happens, and the team marches down the field, and they march down the field and they score, and then the snapshot is different, right? How's that for as a sports analogy? I don't use too many of those, but there you go. My Missouri Tigers won actually on Saturday. Surprise win over the last year's national champs. So Surprise, surprise, we typically lose. Anyway, so therefore, when we use a number from the balance sheet in these ratios, we use an average of last year and this year. So I'm going to do number 7 for you. What a gift. So again, the numerator of number 7, which is collection period without retention, the numerator is the accounts receivable. Well, we're going to average the accounts receivable. So I'm going to say accounts receivable, and this is without retention. So we're not going to include retention in this ratio. So it's first we take the average accounts receivable, and it's the current year plus last year divided by 2. And then we take that times 365. And I could use some more parentheses here, but the order of operation built into Excel takes care of this for me. So that's the numerator is the average accounts receivable times 365, and then I divide that by the revenues. So I will divide it by revenue. And there is my ratio. And so some of these are trickier than others, right? And again, we do the average when we're going to have when we have a ratio that has some balance sheet numbers and some income statement numbers included in the same ratio. Now, so you'll do the same thing on number 9, except you'll include retention. So, oh, is that 9? Yeah. So for 9, which is collection period with retention, you'll do the same thing, but your average, you will include, instead of just the 402 and the 308, you'll include 402 plus the 25, that's one term, 308 plus 21, that's the other for the previous year. Then you'll add those up, then you'll divide by 2, then you'll be good to go. You still multiply it by 365, and you still divide it by revenue. So that's going to be your number 9. Number 8 and number 10, receivable turns is simply 365 divided by the previous ratio. Then we're going to get into 11, which is the average age of accounts payable. And so you'll have to look that one up. I will hope that you have your book somewhere. I know you might have to crawl out of bed to go get it. That's okay. And average age of accounts payable. Again, you're going to need to average the accounts payable because this is a balance sheet and income statement kind of ratio. 12 is assets to revenues. Again, total assets to revenues ratio is, well, we'll talk about that when we get there. You're going to get there sooner than I am. Working capital turns is the last one on this list. And that also, you'll also use an average for that. And you'll want to look that up. That's part of your exercise, part of your work, not mine, is to maybe look that up. So I'm going to give you, let's say till 9:05, 20 minutes, and work on these ratios. When we come back, I will review them. Have no fear. uh, I will review those ratios, and then we'll talk about what you need to do with it. Make sure you get them done, and send them in. Uh, it's 8:45. I know you're going to have questions. I'm not going to answer any questions during these 20 minutes. I want you to work on it and knock it around and see what you can do with it. Give it your very best shot independently. Struggling is sometimes good, and it's not like you're going to be you're getting credit for doing this in class, but it's not like you're going to be scored. So don't don't fret. Um, and we'll come back, and the questions you have, I will, I hope, be able to clear up as we go through the calculations. Um, so I don't see any questions at this time. Excuse me. So so you've got it there, and we'll be back at let's say 10 or 10 9:05, and we'll pick up there. I'm going to shut off audio and video for this time and let you work away, munch on some breakfast, have a little coffee if you drink coffee, and work hard for when we We are back. 9:05. We have just a few minutes left, and I'd like to go through and talk about these ratios that you just went through and calculated. Talk about their meaning a little bit, and of course, make sure that while I said the final number doesn't matter, we want to at least know how to calculate that final number. So we'll talk about that. I'll demonstrate that a little bit too. So here we go back to the spreadsheet, and let's talk about these. So first of all, this is the collection period without retention. We'll do the collection period with retention here in a minute, and that was 35.08. So what does that really tell us? That's that it tells us essentially the average time that our accounts are in receivable. So at 35.1 kind of gives us an idea of how long our money is tied up in accounts receivable. That is the time between, right, you bill somebody and they pay you back. So you have incurred the cost. This is kind of a payback sort of measure. You've incurred the cost and you have billed the supplier, the customer, if you will. You have billed and you're waiting to receive that money. So your money's been tied up during that time. So you really would like this to be a small ratio. And it's because we took it times 365, it's average days, kind of an average number of days that your money's tied up. The next one is receivable turns, and again, we're doing without retention right now, and this is very simple, right? This is the 365 days in a year divided by the average time for that turn, if you will, the collection period, and so that gives us 10.4. And so you want this to be a higher number. The higher, the better. The turns, whenever you have a ratio, a calculation that calculates turns, typically you want that number to be higher. The higher, the better. And this is the number of turns of your receivables. And the smaller means it's slower. The higher the number means it's happening faster. You're getting those receivables satisfied faster and faster over time. So certainly these numbers are going to move in concert. As the collection period goes down, your turns goes up, and vice versa. Just different. They tell you the same story, just with a different language, if you will. Okay, the collection period with retention, as I said, is just like without. I'm going to give you the number, but I'm not going to calculate it here. But instead of this G8 here, instead of just the 402, it's going to be the 402 plus 420 plus 25. And instead of H8 here, instead of the 308, that number will be 308 plus the 21, and that's the only difference in this calculation. You then take it times 365, and you divide it by 2. You take it times 365, and we're still dividing by revenues, right? So it's still the same. The rest is the same. And if you do that, of course, your numerator here is going to go up, right? So the number that you get, you would expect to be a little bit larger, and it's 37.4. So if you calculated and you got that, then you got it. And if you didn't quite get that, go check your formula again and just make sure that you added. You got to. Uh, the good news is that since you're adding all this stuff up, you can just add in the retention numbers on the tail end, and as long as you add those up all up together before you divide by 2, you're still going to you'll get the same answer. So it should be pretty straightforward. And because of this formula here, right, 365 divided by the collection period, I can actually just copy that formula, and this will give us the collection period with retention, and that's 9.76. That's the answer you should get. You should have gotten for that. 11. We're fading fast here. 50.1 is the answer you should have gotten for that. And remember the accounts payable here. The formula, average age of accounts payable, that's number 11. The formula is the accounts payable times 365. And so remember the accounts payable, we're going to have to go down here and take accounts payable. And I think I included retention here for my number. The accounts payable, just add these guys and add these guys and average, take the average and take that times 365. That's the numerator. And then the denominator here is materials plus subcontract. So we would go down here and get our materials expense, and add the subcontracting expense. So we'd add those two numbers together. That's in the denominator. And that would give us then our number 50.1. Let me just very quickly give you these other numbers. 0.28, this is total assets over revenues. Assets to revenues ratio. Total assets divided by revenues. That's pretty straightforward, I think. Working capital turns is a little more complicated, and I'll need to talk about that just a little bit probably next time. It's revenues minus subcontracts and over the working capital, and we'll talk about that a little bit. This number, if you got it, this number is 11.2, by the way, and the working capital itself is 200,000, 638. So that's working capital. Okay, so in the book it said 0.25 for number 12. 0.25. That could be. That could be. I checked the book. The book probably. I don't have that right in front of me, so I don't know if I wrote that down wrong, if I wrote that number down wrong, or not. But yeah, check that out for sure. Don't let me be a liar. Assets to revenues, 0.25. Look at that. I might have used oh, that's a different. Oh, that does look like, yeah, 0.25. We'll talk about that next time because we're running out of time. So thanks for pointing that out, by the way. Yeah, you got to keep me honest. I guess I make mistakes after all. Okay, so we've got a little bit more to cover here. And how do you know when you need to average the 2 years? Just use the current year. You average whenever you're using the ratio that crosses two boundary lines. That is, whenever you're using both the balance sheet and the income statement, that's when you average, when you got both those included in the ratio. And that may be the mistake I made in calculating that number now that I think about it, because 0.25, that makes sense. Okay, we're out of time. We'll have to discuss this a little bit more in the pro forma stuff that's coming on Thursday. You'll see some announcements and homework assignments coming up. Thank you for your patience. I hope this made a little bit of sense. The good news is that when you're working for a decent sized company, or even a small one, you have an accountant, all these things get popped out automatically. You just have to make management sense of it. We'll talk about that next time as well. I hope you have a great couple of days, and I will see you then on Thursday.